Welcome to the deep dive. We're jumping straight into the sources today, and they really paint quite a dramatic picture.
They certainly do.
Inflation seems, well, stickier than maybe people expected, and at the same time, you've got central banks signaling rate cuts.
Which inevitably means one thing, doesn't it?
The money printers are warming up again.
Exactly. It feels a bit like history rhyming, but, with a very modern twist. Hard assets look like they're gearing up for something significant.
But the old ways of looking at it, like the Bitcoin halving cycle, that 4-year rhythm, it just doesn't seem to be the main story anymore.
No, that's not the primary driver now.
Right. So our mission today is really to cut through that noise. We want to find the real engine moving these hard asset markets. We need to look past Bitcoin supply changes and zoom in on this idea of the liquidity cycle. What are central banks actually doing? And where is all that money going? Okay, let's unpack this.
So to really get the liquidity cycle, we first need to be super clear on how central banks, like the Fed, actually, create money.
Right. Money printing gets thrown around a lot.
It does. And it's not really about tax revenue or even borrowing in the way most people think. Banks have accounts with the Fed, right? To lend to those banks, the Fed basically just tells a computer to increase the number in that bank's account. Mark it up.
So it's less like borrowing money that exists and more like just, poof, new digital dollars appear.
That's pretty much the core of it. And understanding that has really changed the game for investors, especially anyone sitting on a lot of cash.
And the classic example here, we saw this in a few sources, is Michael Saylor's whole melting ice cube thing.
Right, the analogy.
He had, what, $500 million in cash?
Yeah.
He thought that was the safe, conservative play.
Yeah.
Earn maybe 2–3%.
Yeah, that was the initial thinking. But then interest rates basically went to zero.
Just when the Fed started turning on the taps in a huge way.
Exactly. And when Saylor actually dug into the mechanics, the monetary supply itself, he realized the issue wasn't just earning zero interest. His cash was actually losing value, being debased.
Okay, hit us with those numbers, because they were pretty shocking, right? The real cost of just holding dollars.
Yeah, they really were. He calculated that the base money supply, it had been expanding around 7% a year for about a decade. But the real inflation, the kind that pushes capital around, especially in assets, that was much higher.
How high?
Well, for holding equities, he figured the effective inflation was maybe 7 to 8%.
Okay, still high, but the bond number, that was the one that jumped out.
Yeah, he put the inflation rate on holding a long bond at, wait for it, 22%.
22%. Hold on, that seems massive. How did the source get to that? What kind of bond do we talk about?
So that figure specifically tracked MicroStrategy's holdings of long-duration treasuries during that period when rates had tanked. You combine that 7% monetary expansion, that debasement, with the lost potential yield.
Right, the opportunity cost.
Exactly. It's translated into this incredibly punishing negative real return. So for Saylor, holding $500 million cash earning zero suddenly looked like a negative 10% real yield.
That's the ice cube. $150 million just gone, melted away.
Pretty much.
So, okay, if holding cash is that risky, as Saylor's situation shows, where does that money actually go? What's the alternative?
And that fear, that anxiety about melting cash, it leads us right to the new core driver we're talking about. We've kind of established the move into scarce assets isn't really about the halving anymore.
Right.
The real catalyst is liquidity. Specifically, how much the money supply is expanding. That's the metric known as M2.
M2. That's key here. It's not just physical cash, right? It's broader.
Yeah, much broader. Cash, checking accounts, savings accounts, money market funds. Basically, the easily accessible money sloshing around the system. It defines the whole financial weather system, if you like.
Okay. So how does M2 drive things?
It's a fairly clear cycle, actually. M2 goes up.
Money supply expands.
Right. Then, almost inevitably, you see asset inflation rise. Capital then feels forced out of things like bonds and treasuries that aren't keeping up.
And it runs towards hard assets.
Yeah.
Scarce things.
Exactly. And if you look back, ignoring all the, crypto-specific narratives for a moment, every single major Bitcoin bull run, 2013, 2017, 2021, lined up perfectly with periods of significant money printing and M2 growth.
And the current data on global M2, it looks pretty stark.
It really does. One source we looked at mentioned 12% annualized growth rates in global M2.
12%. That's way, way beyond the Fed's, 2% target.
Yeah.
And honestly, it feels like the central banks haven't even fully opened the floodgates yet.
That global picture is really the core argument. It supports the idea that money supply growth is the key variable now, if you're still just watching Bitcoin block rewards.
Or mining difficulty.
Yeah. Instead of watching the central bank's balance sheet, you're probably, well, you're missing the main signal driving the market.
Okay, here's where it gets really interesting. Because when you look at the charts, especially comparing gold and Bitcoin, there's this pattern that seems to repeat. It's quite striking.
Ah, yes, the warm-up act and the main event. We see this pretty consistently. Gold tends to make its move first.
The safe bet, the analog trade.
Kind of. It's often the first place institutional money flows when liquidity really starts pumping. It's like the initial shock absorber.
And then what happens?
Well, historically, once gold peaks, maybe cools off a bit, starts consolidating. That seems to be the cue. That's when Bitcoin tends to wake up.
And steal the spotlight.
Pretty much, yeah. Steal the show.
And that rotation can be pinpoint accurate sometimes.
Sometimes, yeah. The sources pointed to one specific instance, October 9th, where Bitcoin apparently saw a big correction, like 17.83% down.
Okay.
And that exact same day was when gold hit a new all-time high.
Wow. It's like the old guard handing off to the new digital contender.
It does have that feel, and it makes a lot of sense if you think about the core difference between them. Scarcity.
Right. Because gold isn't truly finite, is it?
No, exactly. As Alex Stanzik pointed out in the material we reviewed, gold supply does increase. Miners dig up more, about 1.5% more every year, give or take.
But Bitcoin.
Bitcoin is different. It's absolutely mathematically finite, capped supply.
And we might be seeing that handover happening right now. Gold's had a huge run.
It's strongest in years, yeah. And recently, it's pulled back quite noticeably. Historically, that kind of drop, that cooling off after a big run, that's often been the signal.
The signal that capital is starting to migrate from analog scarcity to digital scarcity.
That's the theory. From the predictable to the potentially inevitable, you might say.
So if liquidity is driving everything, the massive question right now is, what happens next? Does liquidity keep expanding, or does it contract?
That's the billion-dollar question, isn't it? Or maybe trillion-dollar.
Looking at the indicators, Fed funds, futures, jobs, data softening, just general market nervousness. What's a consensus?
Well, the strong expectation, reading between the lines of Fed speak and looking at futures markets, is that central banks will take their foot off the brake. Maybe not tomorrow, but inevitably.
The more expansion.
The prevailing view seems to be yes. Continued liquidity expansion, maybe ad infinitum, as one source put it, because the political pain of a really deep recession is just too much to bear for most governments.
Which, for Bitcoin, means...
It means the overall macro trend should still point up. Bitcoin, the argument goes, will continue to sort of catch up to or absorb that constantly expanding liquidity.
But hang on, what if that consensus is wrong? What if there are, say, strong deflationary pressures we're not seeing, or maybe a government gets really serious about only fighting inflation and keeps things tight for longer?
That's absolutely the counter-argument, the risk. And you could definitely see temporary drops, big ones maybe. Bitcoin pulling back to, say, $100,000 or $90,000. Totally possible. Volatility is part of the game.
So those wouldn't be seen as the trend breaking.
According to the sources we looked at, smart money would likely see those not as a collapse, but as buying opportunities. Because that underlying pressure for monetary expansion, that bigger trend, is just seen as too powerful to ignore long term.
Okay, and just to give people a sense of the scale here,
Right.
Let's talk about that 2% rotation idea from gold.
Right. This is a fascinating thought experiment. Gold's market cap is, enormous compared to Bitcoin still.
Trillions versus, well, less.
Much less. So the calculation suggests that if just 2% of the capital currently invested in gold decided to move over to Bitcoin,
Only 2%.
just 2%, the price impact on Bitcoin would be huge. It could potentially send the price surging to $165,000 almost instantly.
Wow. That really shows the potential energy stored up if this rotation really gets going.
Exactly. It highlights the asymmetry.
So this all points towards a sort of new cycle, doesn't it? A modern digital scarcity cycle. Almost like a feedback loop we need to watch. What are the phases?
Yeah, it's like a dance that repeats. Phase 1, Fed cuts rates, M2 expands, you start seeing asset prices inflate.
Step 1, liquidity flows.
Step 2, capital gets scared of its cash or bonds losing value, so it runs to hard assets. Gold usually leads here, takes the first wave.
The warm-up act.
Step 3, then Bitcoin wakes up, starts its more parabolic move, steals the show, outperforms gold.
The main event. And then...
Phase 4, Eventually, they get worried about inflation again, so they tighten policy. Liquidity dries up for a bit, markets cool down until the next crisis hits.
And forces them to print again. Rinse and repeat.
Pretty much. But now, with this digital escape hatch, Bitcoin playing a bigger role each cycle.
Okay, so while investors and maybe even some institutions are playing this rotation game, what about the official sector, the central banks themselves? How are they trying to adapt to this new world?
Well, it's interesting to contrast this fast-moving market with, honestly, how outdated parts of the traditional financial systems still are.
You mean like sending money overseas?
Exactly. International wires.
Yeah.
Sometimes you still need to physically go to a branch. They cost a lot, maybe $50 a pop. They have cutoff times. Good luck sending money after 5 p.m. Friday.
Right. And the addressing systems aren't even universal. It's clunky.
It's incredibly clunky for a multi-trillion-dollar global system, still running on things like Swift, which is decades old.
So if we connect that inefficiency to the bigger picture, even the Fed is starting to acknowledge that this crypto stuff, distributed ledgers, it's not just fringe anymore.
That's a really significant shift in tone, actually. Fed Governor Waller said recently these things are increasingly woven into the fabric of finance. And crucially, it's not just crypto startups doing it now.
Who else?
He mentioned banks, big asset managers, tech companies. They're all getting involved.
Okay, that sounds super bullish for crypto overall,
Yeah.
but there's a catch, right? What is the Fed actually interested in for its own use? Not buying Bitcoin, is it?
No, not at all. Their focus seems very specific. They talked about conducting hands-on research on tokenization, using smart contracts, and looking at AI and payments, but specifically for use in our own payment systems.
So they want the tech, maybe. The efficiency.
That seems to be the interpretation. They're likely looking at building their own stablecoins, or maybe even a central bank digital currency, a CBDC. They want the speed and efficiency.
Without giving up the control that something like Bitcoin represents.
Precisely. Control seems key.
Okay, so let's try and bring this all home for you, the listener. The narrative seems to have shifted. We've gone from the predictable internal Bitcoin halving cycle
to this broader macro-driven liquidity cycle.
And now it feels like it's morphing again into this powerful digital scarcity cycle.
Yeah. And this matters. It really matters to you personally because of the potential for some kind of monetary reset down the line.
What do you mean by reset?
Well, if we really are heading towards a sovereign debt crisis, which some of the sources suggest is a possibility, there are going to be winners and losers. And the crucial thing is there probably won't be a do-over.
Like those hypotheticals we saw. If a government suddenly said, okay, we're going back to gold and reprice gold way higher, like $20,000 an ounce.
Or imagine if the U.S. government decided for strategic reasons to build a massive Bitcoin reserve. That could dramatically reprice Bitcoin almost overnight.
And if you didn't already own some of that asset before the announcement,
you'd be left behind. You wouldn't benefit from that revaluation.
So the bottom line is,
given the, let's say, near certainty of ongoing monetary debasement over the long term and the fact that you likely won't get a second chance to reposition after a major shift, the message from these sources is pretty clear.
You need some exposure.
You really should consider having some portion of your wealth in assets that the government simply cannot print more of. That means traditional options like gold, maybe silver.
And Bitcoin.
And yes, the ultimate digital scarcity asset, Bitcoin. Because the money printer, whether the dollar stays as paper or becomes digital in a CBDC, that printer is probably always going to go BRRR eventually.
So next time you see headlines about the Fed cutting rates, or you see that M2 chart starting to tick up again,
remember what it likely means. It's not just financial news. It could be the starting gun for the next phase of this huge migration of capital into scarce assets. That's the real signal to watch.